Direct indexing, 1.27% more after-tax return with less risk. Is direct indexing the future of investing? Hi everyone, I hope you're having a good week and welcome back to Markets with Marcus. So, equity indices are still near record highs when we're taping this, and we've gotten a few questions about direct indexing for your investments. Now, these questions came in two flavors, so to speak. One, when the glass is half full, you want more upside. And indeed, there are two studies out there that show that a direct indexing strategy may give you an after-tax advantage in your investment. Vanguard sees up to 1.27% potential after-tax additional returns, excess returns, from a direct indexing strategy if you use tax loss harvesting. We'll explain later what that means. Schwab had a similar study. They come to a bit of a little lower additional annual return post-tax, 1.03%, but still you get the picture. Direct indexing may give you more after-tax return. That said, if your glass is half empty, direct indexing may also give you an advantage in the sense that you can customize your portfolio and, for example, reduce or avoid exposure to potential bubbles. And that's clearly also a topic that seems to be top of mind for many in our community, especially if you look at the top exposures you have when you buy a S&P 500 index. So for example, if you buy VOO, Vanguard's S&P 500 ETF, 9 out of the 10 largest holdings are tech companies, making up a combined 36% of the portfolio. And if you ask me why 9 and not 7, the famous 7 that make up our tech bubble, if you want, it's because Google is in there twice with a Class A and Class C share, and you also have Broadcom, not a member of the original Magnificent 7, but also a leading semiconductor firm and part of the whole tech boom and AI enthusiasm out there. So, with that in mind, we'll dive into 3 topics today. 1. What is direct indexing and how does it work? 2. What are the advantages and disadvantages of direct indexing? And 3. Who offers direct indexing and what is our perspective? So let's get started with the first question. What is direct indexing? How does it work? Well, at its core, the idea is simple. Direct indexing simply means that you own all securities in an index and not just a fund. So to stick with our S&P 500 fund example, if you own the S&P fund, you have one position in your portfolio and it will show us VOO for Vanguard's fund, IVV for iShare, FXAIX for Fidelity, or SWPPX for Schwab or some other fund. When you have a direct indexing approach, you'll see 500 shares, S&P 500. So if you open your account, you see a long list of shareholdings that you have, starting now with the top 10 names we quickly looked at before. So that's the basic idea. Own the underlying stocks, not just a fund that bundles it. So one side remark, direct indexing works for stocks and bonds, but it's more popular for stocks. Simply for the reason that stocks have more volatility, more opportunities for capital gains and losses, which gives you more opportunity to play with the tax advantage. We'll get back to that later. So, if you own stocks directly, or bonds for that matter, you know that we here at Diamond NestEgg are generally big fans of owning your securities directly, because it gives you what we call the 3C advantages. Now, let's look how direct indexing performs against those criteria. So, clarity, full checkmark, full green checkmark. If you do direct indexing, you always know what securities you own. Complete clarity and transparency. In terms of control, it's a half checkmark, checkmark in brackets, or however you want to express it. You do have some control over what you hold. You can influence the selection, the buying, and the selling of your holdings, of your shares or bonds if you do that. But it's limited in the sense that at the end of the day, it's still an underlying index, and most direct indexing providers will offer you automated monitoring, control, maybe even automated tax optimization. So yes, you have influence, but it's not the same as fully managing yourself. But it's definitely better than a fund that you can't influence at all. And finally, cost. So with bonds, owning your bonds directly usually gives you a cost advantage over a fund. May not be big, but it does. Well, for direct investing, it's usually the opposite, because direct investing is relatively new, it's relatively sophisticated, it's relatively expensive. We'll tell you that later. But clarity, control, it does give you an advantage. So this leads us to the question, if holding stocks does have its advantages, why was it not popular for a long time, and why is it suddenly becoming popular again? Is it back to the future? Well, there were 3 innovations in the past few years that made direct indexing for retail investors possible. First, zero commission trading. Clearly, if you have to pay a fee for every single trade you do, it's much cheaper to buy 1 share of an index fund than 500 shares of the underlying shares. So without zero commission trading, direct indexing would not work. Second, fractional shares. So if you have only entire shares that you can own, it doesn't really make much sense to try replicating an index if you don't have a huge portfolio. It just wouldn't work out. On the other hand, if you have fractional shares, it suddenly works. You can suddenly own 1/10 of a share of Broadcom to get to your index weight, and that's even more important for the smaller values in the index. And finally, something that's gotten even more important recently, and where probably we had the most recent progress, computing power and AI tools. Direct indexing is relatively labor intensive or tool intensive, because you need to monitor, rebalance portfolios at regular intervals, which means you need someone to do it. It's way too expensive to do that with human labor for retail investors, so you need computing power and AI tools. And that's where a lot of the latest progress has been. So how does direct indexing work in real life? Assuming you try to understand that, it's relatively straightforward for you as a user. First, you open an account. That's usually a separately managed account. So it's a separate account. You can't commingle it with any other account. That account is ring-fenced, so to speak. And that's where you have the direct indexing and the agreed rules for direct indexing with your provider. Second, you select your index. You take the S&P 500, for example, if you want a broad-based blue chip market index. But you could also select the NASDAQ Composite for tech and growth, or the Dow Jones Industrials if you want to be a bit more defensive. And there are any other amount of indexes you can use as the basis for direct indexing. Then the next step, we said before, you can customize your portfolio. You don't have to. You can also just replicate the standard index that you choose, but you can personalize your portfolio. You can add, reduce, exclude individual names or entire sectors. For example, we said before, you can, for example, underweigh tech if you think that's maybe in bubble territory. You can overweigh health care stocks if you think that's the future. And you can also add any other rules like no tobacco or something like that. Then the next step, you build the portfolio. That's usually already pretty much automated. Your provider or a machine will do that for you. You may have to make a few decisions along the way. For example, if your investment isn't that large and you have an index with many parts, many constituents, you may not fully replicate the index. You may still do a bit of sampling. For example, if you were to replicate a bond index, that has several thousand constituents in some cases, given how fragmented the bond market is, wouldn't make much sense to really replicate that in full. Now then, in direct indexing, your platform buys the required positions. And after that, and that's also important, it's not fire and forget, but then it needs to be constantly monitored and rebalanced. For example, the S&P 500, it's usually quarterly rebalanced. Now, Direct indexing comes in two variations, either fully automated, so like a robo-advisor, subset of a robo-advisor if you want to use the term, or advisor-led with support by AI tools, where you still have an advisor who you can discuss your decisions with, you can make proposals, and then you can together, or your advisor does it for you, input your preferences into the tool. So now we know what direct indexing is, basically own the shares, not the index, how it works, pretty much like a semi-managed portfolio. Let's now move on to the next section of this video. What are the advantages and disadvantages of direct indexing? So the first one we already discussed a bit. The first advantage, the first reason speaking for direct indexing is customization. You can customize, you can personalize your portfolio by adding your personal twists to an underlying index. Now, to be honest, this may or may not give you a better risk-return profile. That really depends on what you decide to add, but it may let you sleep better at night. So if you're really not comfortable with the tech bubble, but you want still something that's close to an S&P 500, going into direct indexing, personalizing your exposure to tech may let you sleep better at night, may give you this feeling that that's the investment you want, and that's worth a lot. You don't always have to chase the latest potential basis point of return if that keeps you up at night. So the second reason for direct indexing is the potential tax advantage that we managed at the beginning, and the underlying mechanism, which is called tax loss harvesting. So, bit of background. So, if you buy an ETF, you as an investor only realize capital gains or losses when you sell your shares. Yeah, you buy a certain ETF at, let's say, 100, you keep it, then you sell it at 120, you made a capital gain of 20. And you buy it at 100, in a bad market, you have to sell it at 90, you have a capital loss of 90. So far, so good, so straightforward. However, there is no way you can access any capital losses from individual positions in the ETF without selling the entire ETF. So if you have now within these 500 names, some winners, some losers, they're all trapped inside the ETF for you as an investor, so to speak. You really can't access them in a targeted way. So now, if those capital losses are trapped inside the ETF, in theory, also in practice, the manager of the ETF should still be able to use those capital losses to offset against any capital gains, and that's definitely true. However, ETFs are very tax efficient, and a mechanism called in-kind creation and redemption essentially minimizes the creation of capital gains inside the ETF. I won't explain in full what it means, but essentially you swap portfolios and that's capital gains tax-free. So because there are very limited capital gains inside the ETF, these capital losses inside the ETF may also not be fully used by the manager. So in a way, you could say these capital losses from individual positions within ETFs are really asking to be leveraged. So, side remark, so most comparisons for the advantages of direct indexing compared to ETFs, for the reasons we just discussed, that's the baseline for most investors. With mutual funds, it's a bit more complex. You get allocated capital gains and losses potentially, but the picture is similar in the sense that you as an investor do not control what you get allocated. That's the managers. You really essentially have only one decision you can make, buy or sell the entire mutual fund. So that's different when you do direct indexing, as we said. And the important thing to know is that there are usually some capital losses inside a large portfolio, even when the headlines are good. So for example, even though at the time of this taping, or strictly speaking at close of market yesterday, the S&P 500 was up 14% year to date, plus 14%. However, inside this overall strong performance, some names, some well-known names that you may have heard of, showed significant losses, usually driven by specific factors to their name. So Lululemon down 55%, Dow Inc., the chemicals company, down 44%, and Moderna, the vaccination provider, down 34%. Now, if you own an ETF, as we said, there's no way for you to access those capital losses unless you sell your entire S&P 500 ETF, but then you would show a capital gain of 14%. So the capital losses, those potential capital losses from Lululemon, Dow, Moderna, and many other shares, just sit inside your ETF. It's different when you do direct indexing, because you own all those shares individually in your portfolio, remember? So you can sell those names. Then when you sell, you realize the capital loss, and you can use it in your tax return to offset any other capital gains you may have. And nice thing, because it's on your tax return, you don't have to use it to offset capital gains within the direct indexing portfolio. You can also offset any capital gains you have outside the specific portfolio. And that's tax loss harvesting. Now, essentially, you sell some of the losers in your portfolio, you realize a capital loss, and you can use that to offset other capital gains. And up to $3,000, you can even offset it against ordinary income. Now, if that sounds too good to be true, well, there's always one twist, there's always one condition. That's the wash sales rule that the IRS gives you. So within a window of 61 days around your transaction, so not on the day of the transaction, not 30 days before, not 30 days after, you cannot buy the same or substantially identical name. So you can't just sell Lululemon, realize and book the capital loss, then turn around and buy Lululemon again at the new lower price. That doesn't work. Then the IRS will not recognize your capital loss, and that defeats the purpose. So you need either to wait for 30 days after you sold, or you replace Lululemon by a different name that's maybe close enough, but not exactly the same, not substantially identical, as the IRS would say. So if you do that, this means you will have at least a temporary distortion to your index. Because of course, let's say you sell Moderna. To take another example, what do you buy? You could buy BioNTech, but it's a German company. You can buy Pfizer, but that's also a different profile, and Pfizer is already in your index anyway. So that's something to keep in mind, that the tax loss harvesting does come at a certain price, meaning at least a temporary distortion to your index. That's also a reason, by the way, why ETFs can't really do it so much, because they are bound to the index. And as passive managers, they can't do those optimization trades. Now, one reminder, Diamond NestEgg does not provide tax advice. All these examples that we've just discussed are for illustrative purposes only. Always consult with your tax advisor. So we have now two good reasons for direct indexing. You can personalize your portfolio, and you may be able to get a tax advantage, some extra returns from tax loss harvesting. However, there are also two reasons that speak potentially against direct indexing. The first, cost. So I already mentioned that at the beginning when we compared the 3 C's, and the case is relatively straightforward. Again, if you take ETFs as our baseline, most of the ETFs out there charge very, very low fees for basic S&P 500 portfolios. Fidelity 1.5 basis points, Schwab 2 basis points, Vanguard 3 basis points. It's not nothing, but most investors won't notice fees that low in real life. So that's always a good low-cost option. Direct indexing is much more expensive. It's also much more complex, requires much more effort. And we did a quick search, a bit of a listened around, talked to a few people, Googled on the web. So if you go for direct indexing, it varies by provider, not surprisingly, but at least the offering prices are usually in a range of 30 to 70 basis points for large brokerages. This is clearly different by name, different by the services offering. Some have a minimum investment requirement, which again with an ETF you don't really have. And there are also some newer firms out there that may be cheaper and emphasize automation more. It may also look different if you have a more specialized or complex portfolio. But overall, the picture is that direct indexing, you pay for the advantages you get. So the second reason speaking against direct indexing, you are not in a high tax bracket, and or no, you just don't have any capital gains that you would have to tax. Clearly, the tax advantage of direct indexing comes from tax loss harvesting, and if there are no tax losses to harvest and or there is nothing you can offset it against, it defeats the purpose in a sense. So now we know what speaks for and what speaks against in trying direct indexing. Let's look now at the next section, who offers direct indexing and what is our perspective. So as a market segment, direct indexing is growing fast, both with leading brokerages and with newer firms. Everyone is trying to get a slice of this market, and that is driven probably by two factors. A, the potential advantages to investors, to clients, to investors like you and me, from the personalization and the tax loss harvesting, the after-tax advantage. But also, as we said before, from the rapid progress in computing power, in AI tools, in fractional shares, in zero commission trades that make it feasible to offer direct indexing at a reasonable price. So, for example, leading brokerages, Fidelity, Schwab, Vanguard, they all have their more or less openly or branded direct indexing offerings, but there are newer firms as well, often, as many firms often are, tech-led, a bit nimbler. Some are more self-serve, some still combine it with a traditional advisor. Names that come to mind, but without any specific ranking here: Wealthfront, Frag, more on the self-service side, or Evergreen Wealth, recently launched, more on the high net worth side. So who might and who might not consider direct indexing? So you now understand what the advantages, disadvantages are. It's out there in the market, and whether you should consider it or not, I think the first test you should ask yourself is whether you agree at least with one of those statements that would speak for trying direct indexing. 1. You value tax efficiency and tool-supported optimization. 2. You want to add your personal twist to an existing index, the personalization. And 3. You're willing to pay the potentially higher cost for the service. On the other hand, if any one of the following 3 statements apply to you, you may potentially not want to consider direct indexing. 1. You like the simplicity and low cost of index tracking ETFs. That's a true and tested tool, investment vehicle. Why change it if you love it? 2. You're not in a high tax bracket, and or most of your investments are in tax advantaged accounts. So the tax advantage of direct indexing, as we discussed, comes from producing capital losses. So if you can't offset them against any capital gains, and or those capital gains wouldn't be taxed anyway, because they're, for example, in a tax advantaged accounts, that motivation falls away. Then your only motivation to go for direct indexing would be because you want to personalize your portfolio. And 3, why you might not want to consider direct indexing: if you want to completely actively manage the portfolio, if you want to have full control. You saw before, we only gave that like half a check mark. Yes, you have control, but it's still an underlying index. If you want to completely actively manage the portfolio yourself, maybe even do some short-term trading, why bother with direct indexing? Just do a normal brokerage account. So in summary, tax loss harvesting as the main driver for most people to try direct indexing works best in a fully taxable brokerage account, and when you have capital gains to offset, which usually implies a certain minimum amount and tax bracket. So would we consider direct indexing? Well, we here in the Llama family, we like the personalization and the potential tax advantages. if it's a percentage point or a bit more an after-tax return advantage, that's nothing to be sneered at. That adds up over time. So we can see the case for direct indexing at a certain stage in our lives. But we'll need to dig a bit deeper before making a concrete decision. Like many things to do with tax, this requires a bit of a really very personal case-by-case consideration. So that was it today. Drop me in the community a comment below what your feeling is. Would direct indexing be something for you or not? Would you stick with ETFs or maybe low-cost mutual funds? Or are you tempted by the personalization or the potential tax advantages? Let us know. Maybe let us know whether you want to dig deeper on the topic. And looking forward to seeing you hopefully soon again at Markets with Marcus.